All right, welcome to another episode of the podcast yet to be named. We got some good. We're almost there, but we're hoping maybe our next episode we'll have something to run with here.
We're working
Um,
on it.
but yeah, Alan Nays, Matt Bouts. Alan Nays is a CPA. Matt Bouts is a certified financial planner. We're here putting our heads together for tradesmen that are growing their business. Right, Alan?
That's right. Yeah.
Great. What we got on the docket today, the topic is common tax mistakes. Common tax mistakes. Alan is going to be going through his top four that frankly cover a broad swath of different mistakes.
Yeah.
And I'll be providing some insight for what I've seen. But that's really what we got here on the docket.
Let's add to that a little bit. It's
Yeah.
common tax mistakes that cost business owners money.
That
'Cause
cost business owners money, because that's what tax mistakes are, right?
yeah,
I mean, I guess you could have tax mistakes where you're not paying the right amount either. But would you agree, Alan, that it's usually the other way around? That the tax code's designed to make sure you're overpaying unless you're finding every opportunity. Not
yeah,
always.
yeah. It's usually the other way around. Yeah. It's kind of more rare the opposite. But you can make a mistake on your tax return and it doesn't cost money and it's non-monetary. But we don't care about
True.
those.
We
'Cause
don't care
we
about
don't work for
those.
the IRS.
Right.
We work for
Right.
you. So
There we go. There we go. And this emphasizes, if you've been listening to the podcast at all, you know that we are huge on just hammering home the point of how important it is to have a collaborative team. If you own a business, especially of any size, you need to have collaborative experts working together. And part of their process as they help you should be reviewing your tax returns, right? For these kinds of mistakes, right? And so
right.
these kinds of mistakes do not happen. And if you're engaging with people for the first time, a good quality tax pro, make sure they're actually reviewing your current taxes, last year's, and a few years prior, right, Alan?
Yeah, you can amend up to 3 years. Although I don't always recommend amending a return unless it has a substantial impact because you reopen up that statute.
Mm.
The time that the IRS can come back and audit your returns. But yeah, I mean a 3-year review. Let's see what kind of opportunities there are.
See, this is why I love this. This something I didn't know you opened up some new statute for audits. That sounds icky, and I don't want to
Yeah,
do that for a $200 savings to amend a return. Probably have to pay you something to amend my return, and
yeah.
that's the kind of stuff we're talking about. You got a professional looking. It doesn't even make sense to bother, right?
It doesn't. Just like a crime, there's a statute of limitations on a crime, right? Well, there's a
Hmm.
statute of limitations on your tax return as well.
All
And
right.
if it's a closed period, well, maybe let sleeping dogs lie unless there's a gross misstatement that we got to address.
Good. Um, Seriously, folks, I'm learning new stuff every time we chat too. Good stuff, Alan.
Yeah.
All right, so we got four different things that we wanted to kind of hone in on. The first one I know you wanted to discuss is reporting income on the wrong tax form, Alan. What do you mean by
Right.
that?
Well, the example that pops out of my mind is, if someone owns rental property, right? It's supposed to go on Schedule C of your tax return. It's a separate schedule than the 1040.
Mhm.
Uh, I've seen several instances, and as surprising as this is, it comes from self-prepared returns and paid prepare returns as well. So professionals are out there making this mistake. But
Mm.
that rental property will end up on Schedule C, and where that really costs you is on Schedule C. The income from Schedule C, you pay what's called self-employment taxes on it. So you pay your regular tax rate, and then you pay an additional 15.3% on top of that, and that's pretty punitive. Pretty punitive.
Yeah. So to clarify, where should it be going instead of on a Schedule C? Because if you're a business owner, you should be understand what a Schedule C is. Where are you saying it should go?
It should go on Schedule E.
Yeah. Hmm.
It's
Okay.
activity from a passive activity.
Yeah. And then you don't have that self-employment taxes. Where if anybody here is still Schedule C, will go into another topic. But does it make sense to have a different entity there? But anybody that's on Schedule C understands what self-employment taxes are, baby, and they do They do suck, right? You get done paying your income taxes, then it's just like a wallop. So you definitely don't want to be adding to that by having your rental income flow through in your Schedule C. Absolutely
That's right.
not.
No,
Yuck.
very punitive.
Yeah. Boy, these conversations could go so many different ways. But if all you got is a Schedule C, the question is why? Why do you have that and not something else? S corp. You still have the Schedule C, but taking care of that self-employment. That's a conversation for another podcast, right, Alan?
Yeah, stay tuned on that one.
Stay
That's a
tuned.
good
Stay
topic.
tuned on that one.
When to make the S election.
The S election, right? Exactly
Yep.
right. But it doesn't always make sense to do that, right? Yeah.
Right.
To manage income you got. It's all your personal, unique, individual situation. Let's talk about missed deductions. The second thing on the list here, just missed deductions in general. What are we missing out there, Alan?
Oh, this one is a little bit more of a broad topic. There not as much. I don't have a good example of this one is always missed. So this one can vary. But one big one I see that business owners miss is missing out on the self-employed insurance deduction. And this can happen with an S corp as well. And that happens with an S corp because people don't properly report the expense. And the IRS has a certain procedure that must be followed to report that expense. It has to flow through wages, reported in box 14 of the W-2. And I don't want to bore you on all the details.
Yeah, you're starting to bore me. Let's break this down more simply. So the example you're using is insurance. So if you had health insurance as a business owner, you should be getting a deduction for that, right?
You should be, you should be getting a deduction. It goes on Schedule 1. I believe it's line 17. So it's a specific spot of the tax return, and it has to be there or you miss out on that deduction altogether.
Yeah, and I would say this is if you're listening to this and you're like, I don't know what any of those schedules are or what that section is, and I have no idea if this is happening, that's probably a good indication that you need to make sure you've got a team of people that are looking at it. If you're feeling overwhelmed, like, oh my gosh, I wouldn't even know how to look at that, right? I wouldn't even know how to check that. It's something you can just ask. If you're working with a CPA or a tax preparer, just say, hey, did I get credit for my insurance premiums that I paid this year? They should be able to answer that for you. If the answer is no, make sure you get it on there going forward. Maybe amend your return, or maybe go find yourself a new tax preparer, right?
Yep.
Or some other professionals to help you out.
You may have outgrown your tax preparer in that instance.
Yeah. And these are the, this isn't like rocket science stuff either. This is like hitting for singles, I would say. Tax planning. I mean, this is basic tax stuff, right? But these are the kind of things that Alan's saying he sees on a regular basis, right?
Oh yeah, and the little ones add up. If you miss out on a $10,000 deduction here, $10,000 deduction there, the result can be profound.
And I don't, I've got a wife and 3 kids and self-employed. Boy, my insurance premiums are not like chump change. At the end of the year, it's a big wad of cash. If I didn't get that deduction, that's a material amount of money. That's like a trip to Mexico or something in January from Minnesota, at least.
Well, just a little, big time, right? And just a little cautionary tale too. If you have an S corp and you're not properly handling it, the IRS will disallow that. If you got audited, they would disallow it, and could be a $10,000, $15,000, $20,000 deduction that the IRS says, well, you didn't process the paperwork properly, so sorry, you don't get this deduction.
Right.
I've seen it. Yeah.
Yeah. And again, this is even for somebody that, the folks listening to realize that even just me, as somebody who knows enough to be very dangerous with this stuff, the fact that you're saying this, I'm reflecting back on how I'm doing it. I'm like, oh, yeah, I am doing it properly. Thank goodness.
Yeah. Well, they say sunlight is the best disinfectant.
Say it again, Alan.
Sunlight is the best disinfectant. So,
absolutely.
You got to be looking at this stuff to make sure that you're tidy.
Absolutely. Absolutely. Good.
Any
other missed deductions?
Yeah. And this is more of one. It's more recent in the tax code than a lot of other ones. So it's commonly missed and commonly mishandled is the deduction for QBI. So a pass-through entity, a partnership.
QBI, that's an acronym. What does that stand for? Do you know? QBI.
Qualified business investment. I can't remember what the I stands for.
All right.
I know the form. I don't know the acronym.
Well, the point is for listeners that this is a new thing, relatively new. Is it 17?
2017, part of TCJA.
Yeah, it's a new deduction for business owners. Was it 20%? Yeah, so that's what it is.
So yeah, the key there is it's a pass-through business. So your S corp, your partnership, and Schedule C, and even some rental properties qualify for the QBI deduction as well. And I guess because it's more recent in the tax code, I've seen this one frequently mishandled, and this is a big one too.
Yeah,
if
it's
not properly done, this one has a big impact.
Yeah, I mean, correct me if my memory is not serving me correctly, but is 20%? It's a 20% deduction of something. Yeah, right.
20,
which is a large amount.
Yeah, the simplified method, if you're over certain income thresholds and it's based on the wages you pay your employees. But, suffice to say there's a calculation, and that calculation ends up being a big number. And this is one too. Again, it's a self-prepared people. It's like, okay, well, we give them a little bit of a pass because they're not tax accountants. They're not tax professionals. Right. But I have seen this more often than I like to admit from professional tax preparers. And it's a little alarming.
Yeah. Yeah. I'd say so, because it's a big one. I know it makes an enormous impact on the bottom number, the last number when you're cutting that check to the IRS. Yeah. That's surprising and frankly disappointing. Any other missed deductions that you want to point out before we go on to number 3?
No, I think those are the two big ones that I focus on.
Okay, this is one that I will admit. I failed to do this, which I didn't even admit this to you, Alan. We were prepping for 5 minutes before we started the podcast. Failing to make estimated tax payments on time.
Right.
Talk to me about that one as a common tax mistake.
You have your tax bill due at the end of the year, and if you don't make 90% of the current year's tax liability or 100% of the prior year's tax liability and estimated tax payments, you can be hit with a penalty. And it's per quarter. So they want you to estimate your income by quarter and make estimated tax payments every quarter, due the 15th of the day after the quarter closes. So if you don't properly do that, you get hit with a penalty on top of it. And I have clients that kind of go both ways on this. Some clients say, well, I'd just rather keep my money in the bank and earn interest. But, I caution them there because typically the interest you earn in the bank account doesn't equal the interest that the IRS gets.
Right. And I would say on that, I think the important thing is, and Alan, to be fair, you mentioned this right before we jumped on the podcast here, is that you should know very clearly whether or not you are choosing to not make your estimated payments, or, if you know that they're due, you can do them, right?
Yeah.
And the reality is, if you're not making them, you better have a clear strategy of the why, because if I'm not mistaken, there's a penalty plus there's interest, right, on what you're not paying. From the day the taxes are due, right? So the point is with interest rates being higher, it's less attractive than it maybe was a couple of years ago to do this strategy. And I think as business owners, it's like, well, I want to have the cash in my pocket. That's all fine and dandy, but no, eyes wide open, jumping into that and really understand what that costs. Because if it is just sitting in a bank account, I can attest that, you're going to lose that all day long. The IRS is winning. The IRS is absolutely winning.
Yeah, so the interest you pay them is more than the interest they pay you. So they're winning. And sometimes cash flow of our business requires us, we run a little tighter than normal. We're waiting on invoices to get paid, and I sort of understand it. But it to your point, it should be a conscious decision.
Right.
You should go into that eyes wide open and say, if I do this, it's going to cost me this, and I'm willing to accept that.
So the question for the folks listening is, are you making estimated payments? If you are making estimated payments, are you making the correct estimated payments? And if you're not making estimated payments, how much are you losing
Yeah.
with the penalties and interest the IRS is charging for
Frequently,
not
people
making?
don't even know. They don't
Right.
know because it's sort of buried in the bottom line of their tax return.
Hmm.
So, um,
Yeah.
something to look into, something to bring up
Yep.
to your tax preparer.
Good. Failing to make tax payments.
Yeah.
All right. What's the number 4 here is the big one, and it's kind of
Yeah.
broad. I wrote down failing to plan, period.
Yeah. Well, they say failing to plan is planning to fail. And, it's sort of, I always like to say business owners are my people. And, I appreciate what they're doing. They're the backbone of the economy. And I'd much rather see the tax dollars in their pocket than with the IRS. So, you know, a formal plan in place on how to properly handle their taxes and make sure that they're paying the lowest legal amount is sort of necessary.
Yeah. I mean, here's the reality. If you owe tax as a business owner, um, and this doesn't become a problem until it is, right? I always tell young people who are starting out, like, go make a buck, and then we can come up with a plan to address the taxes. You got to make some money first, right? And for the folks that are listening to this that have this problem, they understand that this is something. It is a problem, right? The biggest expense that you have by far and away in your business are paying taxes,
Yeah.
and you need to have a plan. And to that extent, when Alan, when you say the lowest, legal amount, right? That's what we need to be doing. And I can just attest to some of the deep planning, Alan, that you and other true professionals, when they're looking at a holistic picture of everything that someone has going on, not just reviewing a tax return, right? Because that's one of the planning things that you need to do is have a professional reviewing your previous year's tax returns. But that's only so much information. It's really about understanding, what do you have in your investment accounts? What else do you have going on in your business? What kind of capital do you have there? What are your aspirations? Depending on what it is that you want out of your life can dictate the tax plan, right?
Right.
Um, and once your team of folks can really understand those dynamics and you can get them all working together, it allows you to really plan. And it's
Right.
not just about saving taxes today, it's about positioning yourself, your business, and your family so you can save on tax in the future as well. And
Well,
I
that
don't know if you,
requires a comprehensive view of finances, right? I mean, it's sort of a, a bigger project, a bigger engagement. And you're absolutely right. Taxes are typically one of a business owner's biggest expense, and it is simply not enough to file the correct forms on the correct dates. We need a
Mhm,
proper plan in place on how to manage that. Frankly, the biggest expense.
mhm. Yep. And one of the things that I wish I could remember who told me this once. When it comes to the IRS and the IRS tax code, now I don't want to get your opinion on if you agree with this or not. But the IRS and the big tax code that it is, like the stacks of reams of paper, right? What they're essentially doing, what the government is essentially doing, and we can argue all day long about whether this is right or, and there's plenty of people that would argue that it's not, and I may be one of them. The reality is they're what they're effectively doing by having all these little nuanced rules in the IRS code. They're telling you where they want you to focus your time, energy, and resources, right?
Right.
And if you can do some of that, to the extent that it helps, you know, get you towards the goals that you're trying to achieve, then we should do that because it allows us to reduce that tax bill, right? And
Right.
sometimes it'll be stuff like silly stuff, like I think I silly stuff. I shouldn't. I should be careful what I say here, but maybe not. The truth is the best medicine. The stuff like this green energy stuff. There's people that are big on that. I'm not so sure yet. I'm not sold on it. The government certainly is. There's tons of incentives for green energy investments, right?
Right.
There's tax planning opportunities in that space. Whether you agree with the green energy or not, It's your if you like paying less tax, there's an opportunity for you in that space. And
You might
so
not
that's
like
a
green
perfect
energy,
example.
but you like green money. So
Yeah, right. Yes, you like green money, or whatever color the money is. Now that everything's digital, but yes. So the point is, it's just this big playbook where the government's essentially saying, "Hey, you work in this area, we're going to give you this kind of a rebate, so to speak."
yeah.
And I didn't say that as eloquently as the gentleman who told it to me, but yeah, it's essentially they're telling you, hey, you put your money over here, we're going to give you this back. You stimulate this part of the economy, we're going to give you a kickback.
Right.
But yeah, having that financial plan or that tax plan, larger plan, is key if you're somebody who's paying taxes.
Yep.
Mm-hmm.
Yep.
Good, Alan. This has been enlightening. What else? Anything else off the top of your head? Common tax mistakes? Anything else that you see regularly? I might just opine a little bit on, because I look at this through a completely different lens, from the investment world, and I can talk about common tax mistakes that I see. Anything else on your end though that you see?
No, I think those are the big ones that are jumping out. Without digging too far deep down in the memory, I try not to remember all of the gory details. But I'd love to hear your perspective on this from your side of the table. What
Yeah,
do
I
you
mean,
what do you see?
obviously, I don't get into the nitty gritty. You're not going to hear me quoting like schedules and lines. I definitely don't know the tax.
That's good because everyone's going to sleep. So
Yeah, right. Here's what I will tell you though is what I do see oftentimes is, let's say, you're a small business owner, you got 100 grand in a savings account. You don't need the 100 grand. You don't need it for cash flow purposes, but
right,
it's a non-qualified savings account. You're not saving for retirement. And you sit down with somebody like me and I say, look, we can move this money into a simple IRA, right? You're not having to put money out of your cash flow or the cash flow of the business or your paycheck or anything. We just simply swoop some money from your checking account that you've got this 100 grand in a savings account
yep,
and move and repaper it, I would call it, to being an IRA.
yep.
And you get a tax deduction for that.
Excellent strategy. It's hard to beat the return on investment of a tax savings.
It's hard to, very hard to. And I would just point out for any of you folks that are uncomfortable or just maybe, let's call it ignorant to the markets, because I'm telling you, and I understand this because there's lots of things that I'm ignorant to that I won't dabble in. But the reality is the markets do work over the long term, like traditional market investing. But let's just say you're not comfortable with that. I don't want to invest in stocks. You can do that strategy that I just talked about. Have your money in a savings account and make a contribution to an IRA and keep it in a savings account. It's not about investing in the markets. It's
Right.
about just repapering it, putting a tax wrapper around it and telling the IRS, hey, this is how I want you to tax this money.
Right.
And it's just a very simple way to save on some tax. It's very basic, and people just don't do it because they just don't think in that way. Or they think, oh, I got to put this money from my paycheck in there, and I don't really feel like that because I can't afford to do it or whatever. They perceive they can't afford it. Another example of that would be if somebody inherited some money, right? Non-qualified money. And you can do the same strategy and put it towards a retirement vehicle that saves you some tax. So that was one thing that just jumped out at me. It's a very simple thing from my perspective, but it's something that people don't usually think about.
Yeah. Very easy one to do.
Yeah. Another one, I doubt we have anybody that's over the age of 70 and a half listening to our podcast. But if you know anybody that's over 70 and a half that you want to send the link to, anybody listening should do it right now, because this applies to them. There's this little part of the tax code called qualified charitable distributions, where if you have an IRA and you're over 70 and a half and you give any money to charities, and I mean like your church, you guys have a grandparent or a parent that gives money to your local church, they're probably not getting a tax deduction for it unless they're in a high income tax bracket.
Right.
And a QCD allows them to do that. And it's just a little simple thing that I see all of the time. No one's ever doing QCDs, and it's a simple thing, and you just got to know about it. And to Alan's point earlier, what's weird about it is I talk to the tax preparer, and they're like, oh, yeah, I know about those things.
Yeah.
I just don't know enough about my client to know that this is something that I should be talking to them about, because I don't ask them, about what they've got going on. And it should be something they're bringing up, but they're just not thorough enough to do that.
Right.
To your point earlier, Alan.
So I've heard people balk at that and say, well, I just don't give enough. So what dollar amount threshold would you say? Like if you're giving $1,000 or $5,000 or, you really need to look into that.
Yeah, I mean, it really depends on the individual situation. It has a lot to do, honestly, with state taxes too. It's complicated because there's Alan, the SALT acronym.
Right. Yep.
So it depends on the state, but the reality is this is something that's going to be changing. The reason that this strategy I'm just talking about right now is if the tax cuts expire at the end of 2025, which they're scheduled to, this strategy that I'm talking about will change. And it's possible that Congress, depending on who wins this next election cycle, keeps it in there, but it's very possible it changes. And this is a perfect example of why you need to have a team of people who, when this changes, which it will, throughout the rest of your life, tax law is going to continually change. And wouldn't it be nice to have a collaborative group of people saying, all right, taxes are changing. How is that going to affect Matt Bouts or Alan Nays or John and Jane Doe specifically? And what are we doing proactively to make sure we're minimizing how this is going to negatively impact them? Or if it's an opportunity, how are we going to take advantage of it? Right?
Yeah. Let's kick over all the rocks, all the tax rocks, and see what's there.
Kick them all over.
Yep.
All right, good. Alan, this has been a good one. Good. We appreciate everybody listening in, and we'll be back next week with another episode.
Yeah. Looking forward to it. Hopefully this was helpful to everyone, and looking forward to talking about when to make an S election.
When to make an S election. That's what we're talking next. Cool. All right, everybody. Talk soon.